Unless people should attend live, right? That's it. That's just what that means. That's what I think that means personally. um, so what is the risk for a buyer? Lost escrow deposit. We know that for sure. A lost escrow deposit, which is could be a very substantial number. What about other costs associated with that going under contract? What about their application fee to maybe an association, right? What about credit checks? What about the cost they've expended on an inspection, right? What about the cost they've expended on an appraisal? What if they did additional inspections for maybe mold, right? Though that's all money that's lost, right? And what about even time and opportunity? What about if they should have never even considered that property? We're going to talk about that today as well. All of these things are to be taken into consideration when we understand the real risk of not properly conducting a pre-approval, right? To make sure that a buyer is actually purchase ready. Exactly, Jerry. So, just a reminder of where we were last week. Last week, we went over the 5-part buyer consultation. And our discussion this week is going to focus in on financing clarity. Financing clarity, right? We talked about making sure that the buyer is clear, assuming they're financing their transaction, which 80% of transactions are at a minimum, that they understand what financing calls for, right? We talked about the buyer roadmap, right? We talked about in that consultation, you're going to give that buyer a roadmap to the closing table. And in that roadmap includes the first step, again, is that conversation regarding financing or loan pre-approval, right? So we talked about the 5 um, parts, and now we take a step back to talk about part 2, sorry, which is the financing. Okay. So to hit objective 1 and to make sure we're clear before we move into the IPAC framework, we want to make sure we know the difference between pre-qualification versus pre-approval. As real estate experts, you should know this. And you should also be able to explain this to anyone who has interest in purchasing real estate via loan financing. You should understand that a pre-qualification, consider it a conversation. It is an informal estimate based on verbal information provided to a lender. No documents are reviewed, nothing is ran, no income is verified, and the numbers may change. It's simply the buyer saying, "Oh yeah," they're telling the loan officer, "Oh yeah, I make $150,000. My credit score is 800. I have no debt, and yeah, I have $100,000 in the bank." Okay, so lender says, "Oh, with that being said, yes, you are pre-qualified to purchase for $600,000, right? A $600,000 loan." But they've not taken any documents. They've not collected anything from the buyer to verify that information that's provided. So a pre-qualification, guys, is as weak as water. So if a buyer comes to you telling you they've been pre-qualified, you have to be able to explain to them, oh, that's just simply a conversation. If no documentation was collected from you and verified, we have another step to take, right? Versus a pre-approval, that's actual documentation. The lender has in fact collected documents from that buyer and conducted and verified it. They pull credit. The buyer didn't just tell them they had an 800. They pull the buyer's credit report, right? And reviewed them. They collected the bank statements and verified that the funds are there, right? And then they've taken that loan application and they run it through what we call AUS, automated underwriting system. AUS is an algorithm. It's technology that when that buyer's information is inputted, it gives a decision, at least an initial decision right away as to whether or not that buyer is what we call approved eligible or not. Now, of course, that application is going to take further steps, but that's an initial assessment as to the qualification of the approval status of that buyer. What you want to know is the strongest pre-approvals will always win, right? The strongest pre-approvals always win. So with that understanding, we already know when we're conducting a consultation, we're not, if a buyer gives us a document that says pre-qualification, full stop, wonderful. You had an initial conversation. Let's go to the next step, which is an actual pre-approval. All right. All right. So here is the framework that we're going to discuss for the rest of our time together. And that is IPAC. 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 I want you to know that underwriters, they evaluate each buyer the same way every time. Every time. When I conduct consultations with buyers and or even teach this class to buyers specifically, it's calming to them to know that the rules for qualifying for a loan are not going to change based upon the day, right? Generally, right? Or the person generally. There's a framework. The other thing I tell them is it's math. It's math, right? And as we're saying in culture, if the math is mathing, then you're approved, right? And so when we tell them that, that gives them a better understanding, and they understand they're more in control of the outcome than they think, right? So what does IPAC stand for? The I stands for income, the P stands for property, the A stands for assets, the C stands for credit. If any one pillar is weak, the contract is at risk. If the income is a little low, might not be able to carry the payment, it's at risk. If the property has conditions, issues, the condo in Florida, it's at risk. Assets, if we have large deposits that we may or may not be able to source, that deal is at risk. If their credit is right at the line, if anything goes wrong, they won't qualify, that deal is at risk, right? So that is the first thing to understand. The framework for a full loan approval is simply IPAC. You're going to memorize this. So how do we apply IPAC in our consultations? When we get to that second portion in that 5-step process, where we're having a discussion with the buyer about financing, you're going to say, Mr. and Mrs. Buyer, before we look at homes, I want to make sure that you're in a position to win. I want you to know that every loan is approved using a framework that we call IPAC. It's an acronym. I'm going to walk you through each one so that we can eliminate any surprises. That acronym I stands for, the I in IPAC stands for income. We're making sure that income is stable and documented. That lender is going to require that. P is the property that we're shopping for going to be able to be financed. We know that we live in Florida. We know that if you're considering looking at condos, we're going to have to take a special look at those properties to make sure that the lender is going to qualify them, right? Or maybe they're saying, oh, I'm looking at a 5-unit. Well, that's not residential. It's 4 units or less, right? So the property matters, right? And then assets. Is their down payment, their cash to close, is that properly sourced, right? No mattress money, right? And then C, credit. We're going to talk to them about their credit score. And if they say, oh, I have, my aunt is willing to co-sign, well, we're going to talk to them about what that means, right? So this is how we pivot again into part 2 of that 5-part buyer consultation. Before we look at homes, I want to make sure we have a conversation about what the lenders are going to, how the lenders are going to analyze your loan application for approval. All right. All right. So for the purpose of our conversation and you learning this framework today, income. The underwriter's question is simply this: is this income stable? Is it predictable? Is it likely to continue? Because we don't want to qualify, we don't want to approve someone for a loan today and they have a job that they've only been on the job for 30 days. I guess we need to see a little bit longer than that, right? They do not want to set anyone up in neither themselves, right? Because they're the ones loaning the money, nor the buyer who will be subject to foreclosure. They don't want to set anyone up to fail, right? Generally, documentation that's going to be requested from the buyer is 30 days of pay stubs W-2s, if they're self-employed, then a 2-year tax return. Give me 1 second. Getting a little cold. All right. So bring my voice back. Their income was going to be used to determine their expected payment range. All right. Oh, I should have brought a cough drop in here. All right, property. Ugh. My voice is so shaky. Hold on 1 second. Let me get one more swig of my tea. All right. The property must qualify. Is the cold weather? I agree. The property must qualify, not just the borrower. The property must qualify, not just the borrower. And so you guys already know that we're going to look at the condition of the property. Depending upon the loan type, there may be more strict scrutiny of the condition of the property, right? FHA, VA, they're going to want to make sure that the roof, right, electrical, those sorts of items are in an acceptable condition. Versus other loan programs, let's say for example you have a FHA 203K where they're going to be thank you, where they're going to be repairing the property anyway. Well, in that case, the condition is fine. Give me 1 second, guys. All right, now let's make sure I don't choke on this cough drop while I'm talking. I would have a bigger problem. Um, so what are some major Florida considerations as it relates to the property? Non-warrantable condos, the HOA is in litigation, insurability issues, right? We want to explain to the buyer that even though your finances may be in place, you may have cash on hand and your credit may be great. If the property does not the lender will not qualify the property, then we will not get a loan approval. All right. And if you explain this to them in consultation, you'll be able to revert back to this when you guys get out into the field and you see a property and you say, oh no, this is a condo and it's non-warrantable. Now, just because it's non-warrantable, of course, someone's gonna say, well, we closed a non-warrantable condo before. Yeah, you can, but you're looking at different lenders and it's a limited lender and you're gonna pay more and you're probably gonna put more money down, higher interest rate. Does that make sense? Right? Oh no, Marissa, that's terrible. So we want to explain to the buyer that with regards to the property must also meet under lender requirements, and that will drive the properties that we look at, that we tour, and then ultimately the ones that we make an offer on. We want to do our due diligence before making an offer so that we do not get down the road in the closing process to then find out that the property does not qualify. Exactly. Condo tails, co-ops are hard to finance. And so you're learning that. And so you'll be able to explain that to the buyers in advance. So that's, I think Derek, aren't you a lender also, I think? So that's P. Assets. Assets is the cash on hand that the buyer has, right? So the funds needed to close, the lender is going to want to source that. So we're telling the buyers, where are the funds for your purchase, your cash on hand? I would recommend that they have all of that in one bank account, not various bank accounts, right? Checking, savings, even if it's the sale of their home, could be a source of their assets, and that's fine, right? So that's going to be verified. Gift funds. Gift funds can be used, but make sure that the buyer is aware if gift funds are used, there is an additional layer of verification. Now, luckily, we do not have the requirement that we used to have, where the donor, the person that's providing the gift funds will have to provide their bank statements and all sorts of documentation. Now, the donor can wire that money direct to the closing agent, and that'll reduce the amount of verification that's required to documentation that's required to verify the gift funds. All right. Red flags. This is something we can discuss with the buyer. No large deposits. No large deposits. If someone's going to give them money, that's fine, but do not make a large deposit if we're going to be closing in the next 60 days, the next 30, 45 days. It's better for that to be gift funds. Let that be gift funds. If mom's going to give them money, hold on to it and let it be gift funds, right? Of course, do not take out any new credit, right? Do not take out any new credit. So as a realtor, of course, here's this entire conversation is not for you to be the underwriter, but it's for you to prepare the buyer if they've whether they've had the conversation with the lender or not. It's good that they hear from you. First of all, of course, you need to understand it. Secondly, that they hear from you for reiteration. Because I'm going to tell you guys, and it's unfortunate to tell you this, but every lender is not doing the best job with vetting buyers. I'll just say that. And unfortunately, some of it is intentional, meaning they are hoping, but they got a large chasm. They have a large hill to climb to get to approval, but they're hoping they're going to get there. You don't want that. You don't want that. You don't want that as a buyer, as the buyer's agent, and you certainly do not want that as the seller's agent. Oh my gosh. All right. And many buyers, if you have this conversation with them, they may say, wait a minute. The loan officer I didn't give him my bank statements and he gave me a pre-approval. Wait a minute, Derek. Right? It's happening, guys. Trust me. C, credit. In general, so of course, the higher the credit score, the better. However, you guys should know that as a general matter, a buyer can be qualified. They can go lower than 580, particularly with FHA. But if they go below 580, then they have to make a larger down payment. That's the FHA standard. You know that FHA stands for Federal Housing Administration. It is an entity that insures loans, right? It makes lenders whole in the event a buyer defaults. It was founded in order to create liquidity in the market. It was founded to make lenders comfortable with lending money to borrowers with less than stellar credit scores, right? So FHA's limit is essentially 580 to keep them at the 3.5% down payment. However, you guys have probably heard that lenders have what they call overlays, meaning, yes, that's FHA's requirement of 580, but we have an additional overlay for our protection because we don't want to have that conversation of 620. We want to see 620 for an FHA loan. Some may be 610, 600, right? But you need to understand that. So you're having a conversation with the buyer and says, you know, has a lender pulled your credit recently? Are you aware of your credit score? Right? And they say, oh yes, I have a 700. And that was from a credit report. Of course, you guys know the difference between Credit Karma, right? And those different sites. You don't want that. You want an actual credit report from the 3 major credit bureaus. All right? We want to make sure that the buyer understands that that small changes in their credit can make big changes to their loan approval status. All right? So that's C. Now, the other point we want to make sure that we know about credit is the lender is going to use their lowest middle credit score. So if a conversation comes up about, oh, well, we have like I mentioned earlier, my aunt is going to co-sign. Okay, great. What's the aunt's? Just keep in mind that you don't even have to ask the aunt's credit score. Just keep in mind that the lender is going to utilize the lowest middle credit score, right? So if your aunt has if her credit score is lower than yours, then that could be an issue, and you leave it there. Again, you're not the loan officer, but you are the real estate professional who understands financing, right? And of course, you also want to make sure that they do not co-sign any new loans. And of course, do not shop for furniture before closing. Do not close any credit lines that can impact their credit score. Because now, whereas their credit usage ratio was 30%, they closed a major credit line, and now their ratio is up to 60%, right? So do not close credit lines. Do not open any new credit. Do not finance anything before we close. Do not co-sign on any loans before we close. Do not touch anything, right, concerning your credit before we close. All right. So that's the C and IPAC. Very straightforward. Income, property, assets, credit. Memorize this, teach your buyers, and make sure you're able to recall it instantly. Again, you're not the underwriter, but for you, as a real estate professional, you just leveled up your knowledge, right? And your use, your value to a buyer to be able to quickly put their mind at ease about how they're going to how the loan approval process, right? You tell them they underwrite the same way. It's a formula, right? They're gonna look at your income, making sure that you have sufficient income to cover the costs, right? They're gonna look at the property, make sure the property qualifies, is appropriate condition and type. They're gonna look at the assets being your cash available for closing, making sure that it is sourced and you have a sufficient amount. And then lastly, they're gonna look at your credit, making sure that your credit is sufficient. All right. All of a sudden, their anxiety goes down, like, huh, okay, I can do that. I can do this. All right. Let's look at some Florida overlays really quickly. IPAC, we know that lending is a national standard. It's wonderful. I love it. We use the same loan application, whether you're in Florida, Georgia, Texas, California, Nevada. It's not like real estate where the contract templates are different. The same loan application is used in every state, right? Essentially, the same underwriting guidelines are utilized across the nation. However, similarly to the way that we discussed some lenders having overlays to a national guideline, specific lenders having overlays to a national guideline, there are some specific overlays that we should be aware of in Florida, right? Because these are related to our environment, our real estate environment. Now, we talked about condos earlier. We're going to hit it again. We're going to never assume that a condo is financeable. We need to verify early. So there is a list of approved condos, right? And so if your buyer is interested in a condo, the lender that you work with, you should send that property to that lender and ask, is this property already on your approved list? Right? If it is not, I suggest you look elsewhere, right? Yep, the Fannie Mae 1003. That's the application, loan application, right? We know that since Surfside, there are a number of additional requirements. Go ahead, Jocelyn.
If FHA, right? The condos.
Say that again.
That only for, you said you need to contact the lender to find out if they will do that condo. That's only for an FHA loan, right? If only they can finance the FHA, right? Or is it all condos?
All condos. You want to send it all condos. Thank you.
Okay. I didn't know that. Yeah. Thank you.
No problem. Good question. Justin, your mic was a little, I don't know, like hard to hear. Just
what about now?
It's been like that for the last few weeks. I meant to tell you that.
Oh, okay. I'll take everything.
Can you repeat
Uh-huh.
his question, Nicole? Because I don't understand his question.
He asked if it was only FHA loans that the condos should be the condo list should be looked at. I would recommend again that you look at every condo. That's why it's harder to sell condos right now, unfortunately, because of the additional reserve requirements, the maintenance requirements, the special assessments are astronomical, right? On some of them are better than others. The condo questionnaire, right? That needs to be collected from the association. And then remember I mentioned earlier about non-warrantable condos. It's not to say that they cannot be financed, but they will require it's usually it's specialized lenders, right? So lenders who specialize in that product, we call it a product. That's another concept you should know. Loans are like products. And so we're going to talk about this later in the month when we go over um, the lending process for realtors, which will get you more into talking about the different loan products. I want you guys to know that when a buyer makes an application for a loan, there's a list of products, loan products that they qualify for and that they would consider for their purchase, right? So look at products similar to a property. So these are all the different products that you would utilize for. And some lenders have they say we have special products for that purchase type. All right. But again, with non-warrantable condos, you should expect higher down payments and higher interest rates because it's all based on risk, right? The interest rates that are offered to a buyer are all based on risk. The riskier the buyer profile is, the higher the interest rate is going to be, right? The second overlay, you guys know this all too well. The homeowner's insurance, the premiums are crazy, right? You should know that a high homeowner's insurance premium can knock off your DCI ratios because it is included in your payment. And I'm going to show you guys a calculation quickly, and this will make more sense to you as to what that means. The lender has what they call front end and back end ratios. And the ratios meaning they should be called maximums, I guess I should say percentage maximums, because that's what it is. The front end being what is the maximum amount? It's your housing payments. So it's the principal payment, it's the interest payment, taxes, property insurance, HOA fees. All of that is calculated together and you come up with what the lenders call a front end ratio a payment, and they're going to utilize that calculation, apply to the gross monthly income to come up with your front end ratio. Now lenders have different ratio maximums. Front ends can range from generally about 21 to 28 to 31. Now under some circumstances it can be much higher. FHA, if you have good credit, they'll go higher. Different lenders, if you have what's called compensating factors, then now all of a sudden your payment can be higher, right? So let's assume the gross monthly income is $1,000. If your housing payment using the 28 to 31%, your total housing payment, meaning your principal, interest, taxes, insurance, and HOA fees, if it's 28%, cannot be more than what? $280, assuming you have $1,000 per month monthly income. 31%, $310. Your back end ratio is your total monthly debt. So that's not just what you pay for housing, that's everything else on your credit report that you're paying for. Car, student loans, killer. Other credit cards, right? Other payments that you're making will be what we consider your back end ratio. And this number taken together will come up with your DTI ratio. Now, the reason this is important, and you guys, now that I'm saying this, it'll probably, if you've run into this before, it'll jog your memory. When you go out, say, for example, you're shopping, and let's say, for example, a buyer is right on the line, and they look at a property where if the HOA is $300 per month, then they're in line with their ratios. But you found a property that's at $600 per month, their ratios are off, can't qualify. You have to find another property. Does that make sense? Homeowners insurance, same thing. That can throw your ratios off. You guys probably never paid attention to this, but we have a rider for that. You guys know we have a homeowners insurance rider. We have a flood and a property insurance rider that makes the max cost that the buyer can be exposed to. It makes it a contingency in the contract. You say, because you know what your ratios are. So you may say, well, I know if the homeowners insurance is more than $3,000 per year, $5,000 per year, then my ratios are going to be off and I won't qualify. There's a rider for that. It's rarely ever used, but there is a rider for that. It encompasses both flood and the property insurance, the hazard insurance rather. All right. So when you're out shopping, if you've done this before, you oftentimes will find the property, you go back to the lender and say, you'll give the lender the taxes for the property, right? You'll give the lender the insurance estimate for the property. And if there's an HOA, you give them the monthly HOA. You calculate that into their other principal and interest, whether or not they fall within their ratios. This is the full math right here. So when you have a conversation with the buyer, again, if they have not already had this conversation, when it comes to income, this is what income is looking at. Do you have sufficient income to carry the payment? So I'm going to use another example just to make sure we don't miss this. We used before in our hypothetical $1,000 monthly income. And we said that the max, the front end ratio we'll use 31%. If the monthly payment is $300 per month, their total monthly housing payment is $300 per month, we're good. Because we're not at 31% of $1,000. What if that income drops to $750? All of a sudden, we don't qualify. Right? And so that's where we start getting other borrowers come in to bring in their income. So the framework is simple per se. Now, what qualifies as income, that's a whole other conversation, whether the lender will accept as income, how they're going to look at debt, right? If you have debt that's due to be expired, whether or not they're going to include it. That's a whole separate conversation. But this framework, now you're very clear on why homeowners insurance matters. Right? Someone could have easily qualified for a property with homeowners insurance being $3,000 per month. I'm sorry, a year. Now all of a sudden our homeowners insurance is $6,000. Now I have to find a cheaper property, right? Because homeowners insurance is eating into my ratio. All right.
All
All right. Go ahead, Derek.
Do you have a rule of thumb for figuring out insurance before you put an offering? Because it's so hard to get insurance brokers on the line to give you a quote. They want to see the flood. They want to see all the disclosures of property inspection. Do you have like a kind of a rule of thumb of 1%, 1.25%?
That's about it, 1.25%. And I'm glad you asked, because I'm actually going to bring on the guy that we utilized in our group so that he can do a talk for you guys on homeowners insurance.
Awesome.
So I'm glad you asked that, because that's so a homeowners inspector. So you guys have a conversation with an inspector and appraiser, as well as homeowners insurance. So you can see how they look at they analyze the property. Candace, HER and TOR. Tell me what that means. HER. I don't know if I've ever heard that acronym before. I don't know if I've
The
ever heard it.
housing expense ratio and total obligations
Obligation ratio. Yes,
ratio
that is that. Yes.
equals the DTI.
Yes.
Okay, they never put that all together back when.
See, there you go. So, putting it all together. um, IPAC. Again, I've said this a number of times throughout our conversation. You don't need to be the underwriter. That's not what you need to be. But you must understand the framework because it'll allow you, just understanding the framework conceptually will allow you to spot risk early and align with a strong lender. Again, if you ask questions of a lender about whether or not they collected documents, oh no, she's a friend. Excuse me? Like, no, that's not what we're doing. I need you to run AUS, right? Did you verify? And this is important. You guys might not believe this, but we may be at a place where, and again, I'm saying this with an asterisk next to it. We may be at a place where you should not only be asking for a pre-approval, but you should be asking for statements that show cash to close. And I'm just gonna leave that there.
Can we pick up? So is that if you represent the buyer or the seller or both?
You said who's asking for it?
Can you request that if you're working with the buyer or working with the seller or both?
Both. Both.
Okay.
So same way, for example, if you were back in the day when you're saying I'm paying cash and you say proof of funds, it's the same as if you're presenting proof of funds to purchase cash. I need proof of funds to show that you have cash on hand. Okay. There have
What's a
been
good percentage for buyers?
for buyers. Well, first of all, you know that at the very least they're going to need to have whatever the based upon a loan amount, they're going to need to at least have their down payment, right? So if they go FHA, you're going to need to at least see 3.5%, right? And then I would say that you would want to see, rule of thumb, I would say 7% of the total closing costs. On our website, we have, I know a lot of you guys use the seller net sheet, but there's also a buyer closing cost estimate calculator on there. And then also the lender will be able to provide you with that. But you absolutely want to see cash on hand. Again, without disclosing any particular situation, I can tell you that there are situations where buyers get to closing and they are scrambling for cash to close. Okay? All right. So if there is a way for us to avoid that, then let's do that. And the way to avoid that is to request cash on hand. And then again, you're not the underwriter, you're not the loan officer. If for whatever reason you don't feel comfortable asking for the documentation, ask the lender. Do you have confirmation of their cash on hand? All right. Because again, ultimately, you don't want to be part of that 42.7%. All right. So here's a checklist before we make an offer. We want to make sure that we have a full pre-approval, not a pre-qualification. Also, and I didn't hit on this, but I want to make this point since we're going over this checklist. Here's a conversation you can also have. There's a difference between a loan officer pre-approval and a lender's pre-approval. What is the difference? A loan officer has okay, I'll use the example with the seller net sheet because this is something that you guys will be able to relate to. You guys use a seller net sheet on our website and you give the seller an estimate of their closing costs. Great. Even if you're an expert, great. Those numbers are probably going to look different from a HUD that comes from the closing agent, right? Just because they have a bit more insight into the closing fees. Similarly, a loan pre-approval from a loan officer, they're running an IPAC framework. But you have to understand that even the documentation that they examine and they say is sufficient, maybe they see a bank statement and they say, okay, this bank statement is fine. When that bank statement gets to the lender says, well, what is this? And what is this? And what is this deposit? So to get a pre-approval from a lender's underwriter is preferred over a loan officer pre-approval. And so there's another tool in your tool chest. When you talk to loan officer, was this loan officer, was this pre-approval issued by you, or is this a lender's pre-approval? Because there are lenders that will provide you with a pre-approval. Again, remember, a pre-approval coming from the person that will ultimately provide the full approval and funding is different from the person that's facilitating the dialogue with that lender. Look at the loan officer as the person that's facilitating the dialogue with that lender versus the lender themselves. In any circumstance, you would always prefer a lender's pre-approval versus a loan officer's pre-approval whenever possible. You can't require it because not every lender is going to do it. They don't have the bandwidth. But whenever you can, and if you can locate a loan officer that works with a lender that gives you a lender pre-approval, we call it sometimes a TBD. That means we've approved the going back to IPAC. Now you guys have the IPAC. Now you guys should be very dangerous. With a clean pre-approval, you can close in 2 weeks. Anybody want to close in 2 weeks? I don't know about you, but I want to close in 2. And Mary said, let's drive this point home. With a clean pre-approval, you can close in 2 weeks. Here's why. Let's go back to IPAC. With a clean pre-approval, we've already confirmed income. With a clean pre-approval, we've already confirmed assets. With a clean pre-approval, we've already confirmed credit. These are the things that take the most time. With a TBD pre-approval, the only thing we're waiting for is P. We're just waiting for you to find a property to go under contract. And if you do a good job finding a property, doing your due diligence to know that you didn't get a condo that cannot be financed, right? Know that you didn't go try and go under contract with a 5-unit when 4 is your max for residential, right? You didn't try and go under contract with a property that clearly is there, the roof is beyond its life, right? If you do that, title can get you closed in 2 weeks. Especially if you're not on a property that requires an HOA estoppel. That's what takes the longest. And assuming there's no crazy title issues. But this is how you close in 2 weeks, guys. This is how you close in 2 weeks. You get a buyer, you get that consultation completed, and you get them with a lender that is going to give you a clean pre-approval. Now, what does that mean? That means that when that buyer makes that application, they need to come back to that buyer and say, okay, well, income, we're going to need, this tax return, we need one more tax return. They're going to work that buyer up to the point where all you need is the property. Now you're closing in 2 weeks. That's powerful. And trust me, it is way doable. All right. Let's wrap up this checklist and then we have some questions. So again, pre-approval, that's the difference with your pre-approval. AUS, automated underwriting. I'm gonna go ahead and I'm gonna just pull the veil back on that one too. AUS, the result is just as good as the data that you put in. And I'm gonna move on in the checklist. Right? So there was a time when that meant something. Not alone. I would tell you guys that alone, you don't rely on AUS alone because the data is just as good as what you put in there. So if I make a mistake and I put 3,300 a month versus 23 a month, we're gonna get a different result. Okay, I'll move along in the checklist. Funds verified. Do you see their proof of funds, right? DTI confirmed with the estimates. We talked about that. Again, we don't just go shopping and all of a sudden we get to the end and we can't bind insurance that's less than $10,000 a year. That's a problem, right? We want to get you want to get insurance estimates at the front. During the time that the lender is getting their appraisal done, you need to be shopping for insurance, right? Because now that you understand the framework, you know that if you can't bind insurance that makes sense for their ratios, then we have a problem. So we rather know that sooner than later. All right. And then of course, property insurability. Don't run out and go get put an offer on a condo and you know that it's in litigation, right? Reminder, if one pillar is weak, then the contract is at risk. All right. Hands are raised, Candace and Mai. And we are right at our time. Go ahead, Candace.
So I work more so on the listing side,
Mm-hmm.
and I had another agent come through with an offer. So I reached out to the lender, and the lender was telling me, "Oh yeah, we vetted them, went through the AUS, whatever language you guys speak," and said, I asked them, "How soon can we close?" They said 10 days. Sounds great, right? Fast forward like a day or two later, the agent calls me back and says, "Oh, we had to switch lenders because blah, 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 blah." And that family couldn't get financing. So, as a listing agent, and even working with a buyer, what's the best way to protect our sellers?
So a couple of things. One, like we talked about, you want to vet the documentation, right? So they're saying that they, like you said, they said they ran AUS, they said that they're fine. I want to see cash on hand, right? The same way you would show proof of funds if it was a cash offer, can you send us proof of funds for the cash to close? Because that factors into the framework as well. Send me the AUS report. Again, I already told you guys that it's only as good as the information that's put in there. But at least you
So,
receive, you review it, you'll be able to see that information that they utilize. And then beyond that, you're going to write the offer according to what they've indicated to you. If they say they can close in 10 days, well, guess what? In paragraph 8, your loan approval deadline should be 5 days.
can we
You get
ask
what?
for that as a listing agent?
Absolutely.
Because some lenders are like, "Oh, that's personal information. That's their private,
Oh, hey,
financial."
no, no, no. You can absolutely ask for it, number one. Number two, if they don't want to provide it, then you move along. Thirdly, going back to the purchase and sale contract, in paragraph, oh yeah. Where's my binder? In the paragraph, oh,
The financing,
the financing paragraph, I
section
believe,
8, I believe.
section 8 at the bottom, I want to say line 113 or 128. The parties can agree that when the request is made in writing by the seller, the lender basically opens up the chest, gives all the information. You can go directly to the lender and request whatever information you desire concerning their loan approval status. I want to say that's line 128 of the purchase and sale contract. And I don't have my binder in front of me, right?
No worries, we'll find that. But thank you.
No, you're fine. Go find that. I don't have where's my binder? But my binder, you guys know I have the binder with all the printed contracts in front of me. I want to say it's line 128 in the contract provides for the seller to make a request in writing for information concerning the loan approval status, and everybody has to be fully transparent with their status on closing the file. All right. Go ahead.
Thank you, Rocco, for
No problem.
today training. And I
No
have a
problem.
client coming. He is not from Florida. He's looking for the
Mhm.
condominium, 1 bedroom, 1 bath in Brickell area. Is there any listing from here, agent? And then please let me know. And so I'm helping him. So today topic is the perfect for me to digest, and I can help him. So
Mhm. Perfect. I love May. May comes to do business. May said, if y'all have a listing, a 1-1 in Brickell condo, let me know. Hit me up. Last week, she told you guys if you have open houses that you need conducted to contact her. May, drop your phone number, your email address in the chat again.
yes,
So does
and
anybody, if you
the
have it
client,
or go
sorry,
ahead.
I'm sorry, I interrupt. So the client, the one that I'm talking about, he's not from Florida, so he will come in March. So I will meet him. Between that time, I'm sending him email, and
Some
then
options. Okay.
yeah, Mhm.
So
Thank
drop
you.
your email address and your phone number in the chat. You guys, if you guys have a listing that she should consider, then hit her up. All right. Derek,
Thank you.
Hey,
no
thanks.
problem.
This goes back to Candace's question. As lenders were asked for the AUS findings, on the
Mhm.
first sheet of the AUS, it'll say eligible, approved. We don't like to send any more personal stuff. I think usually the first page says they're approved, usually suffices. Um, is it, I mean, common practice? I mean, you being an attorney, to send the entire report with all the
You
personal information?
absolutely can. You absolutely can. Assuming the buyer is okay with it, you absolutely can.
So if the
Because again,
buyer
the buyer,
only, go ahead.
go ahead.
So if the buyer only wants to share the first page, it says they are approved, but they don't want to share anything else. I think all the seller needs to know is that AUS has approved them and has them as eligible. Why would they need everything else? Oh,
So they can, without giving specifics, I can tell you that I've personally witnessed AUS data being manipulated to get to approve eligible. I know I was shocked too, like, are they really doing this in front of me? So I'm just saying, and again, I mean, the thing for me is that does not help anyone. It doesn't help anyone because similarly, I've had situations, plenty situations, where the buyers are sweating. They're getting to closing in because that data was manipulated. I'm going to say this. Lenders will and Derek, you probably know this too. They'll throw Hail Marys. When I
say
say
again.
lenders, I'm saying loan officers. He said because they are lying. Peter is upset. He came. I didn't say it, you did. I didn't say it. I didn't say that, Peter. I did not say it, but in the chat. Yeah. And then
And
yes, Jessica, thank you. Jessica said the buyer isn't okay with it, they don't want their offer accepted. They don't. They don't. And that's what it is because you have to understand that you have to do what makes that seller comfortable with knowing that you can close. Because
okay,
again, I'm not going to use Peter's words, but there has been some mistruths placed into AUS so that loan officers can get the result that they wanted. Full stop. Stop there.
yeah, that's hard to do, but yeah, it happens, but it's tough. Highly
Uh,
regulated. Yeah. Another thing that you mentioned earlier was, don't buy anything new. Once you get approved, don't buy anything. They'll get new credit. Also, another thing that we find a lot as lenders is somebody will switch from a W-2, they'll get a new job as a 1099, and that changes the whole thing or falls apart. Or they switch
mhm,
jobs into a different industry. So they went
mhm.
nursing and now they're in sales and who knows what. But so those two things also keep that in mind when you talk to your
Yep.
buyers.
Yep. What else, Derek? You guys share with each other. Listen, we are all experts, and there's a whole host of information that, I mean, literally, we would be here for hours if we went over all the details concerning it. But we will be discussing, like I said, later this month, we're going to have the experts come in that will specifically discuss um, inspections, appraisals, and the and homeowners insurance. And as well as we're going to go over so you guys understand loan products and just get a further look at the underwriting process. Go ahead, Patricia.
Yes, my question is, I have a buyer who is interested in purchasing in Port St. Lucie. She works in Broward County. Is there a stipulation where there should be a number of miles away from the job that you can live and work when it comes to underwriting?
They're first of all, with that, they're fine. Miami to Port St. Lucie is not an issue. Um, there are certain situations, for example, if let's say, for example, she had taken out an FHA loan and then she needed to move across the country and she wanted to apply for another FHA loan, then now we're looking at the difference between the distance between the new job and the property so that she could take out a new FHA loan, those types of things. But specifically in that case, no, you definitely should not have an issue with that.
I have a lender that's telling her that it's an issue and she got discouraged. And I told her not to be discouraged because there's a way that you can, because I know I have had a buyer that lived in Pompano and she purchased in Fort Pierce, and that's even
Yeah.
further. And he's telling
Shoot me
her
an
no, she
email.
cannot.
Shoot me an email,
Okay.
and we can look further
Discuss
at
that.
her.
Okay. Thank
Mm-hmm.
you so very much, Raquel. You're
No
always
problem.
awesome. Thank you.
No
But
problem.
also, Patricia, also, I'm sorry if I may interject, if that
Yes.
person has a remote job, they can work anywhere as long as the employer gives us a letter saying that they're allowed to work remote, they work remotely. So they can be
Mm-hmm.
far away. If somebody's trying to buy a second home less than 50 miles away, we're not going to approve it because it's just, if second home is more like a vacation, why are you buying it so
Mm-hmm.
close to where you live? So you're trying to get an investment property. So we know we can't do that. So, but as far as the other one, as far as distance, if it's remote, you can work on one coast and buy in the other coast as long as you get a letter from the employer.
Absolutely. And what she was planning on doing, because she's with the school board there, she was going to apply at the St. Lucie County School Board, but not make any changes. She's staying in the same field,
Mm-hmm.
not make any changes until after closing. I'm hoping that's okay. Same field, school board. Even with a letter of offer, he told her no, she could not do it.
So again, like I said, shoot a message because the other thing I will say, similar to how I do with legal questions,
Yes.
there may be more meat on the bone to this one potentially
Okay.
that
Okay.
we can
Okay.
that we can get into today,
Okay. Thank
because
you
we don't
so
want to just
much.
say, oh
Appreciate
no,
your
he's
time.
wrong. That's what we
No,
always
I would
say.
never go back and say that though. I don't like to do that. I
Right,
keep it within myself and just look for other avenues that can help. I rather come up with a solution than to add to the problem. So I
right.
just won't say anything to him about it. I'll let him believe that he
Yeah.
can't, and maybe he may hurt someone else that way though, or discourage another buyer that's pre-approved that was looking to relocate to another
Hmm.
town within Florida.
Yeah.
Is
Thank
that
you
a
both so
lender doing
very
the
much.
loan or just a mortgage broker?
Say that again,
I'm
Justin, or
sorry.
type it in the chat. Your mic is still frying.
Sounds like Darth Vader.
I know it's been like that all week, all month, Justin. I don't know what's going on.
Thank you,
Um,
Derek. Thank you, Raquel. I really appreciate both of your responses. Thank you.
If
not a
I
problem.
may,
Good to see you again.
Yeah,
Go
good
ahead,
to see
Derek.
you.
can I drop in a link that you can go to a website where you can check to see if the condo is FHA approved before you even waste time?
Absolutely.
All right,
Thank you. Thank you for
there it
that.
is right there. Just go there and put in the condo name and all that, and it'll tell you approved, not approved. So that cuts down. It's not a complete list because non-warrantables can still get it, but it's
Hmm.
FHA approved and not approved. So that's it.
And then there's a mechanism for what we call spot approval. I would not recommend that. It takes a lot of time, and the likelihood of approval is not sure. Um, so again, same thing. We want to be fully transparent because someone's gonna say, "Well, that property is not on list, and someone bought the home." Well, it could have been a spot approval. You get what I'm saying? So that's why when we have these conversations, we go very high level, and when you have specific cases or specific um, files or transactions, then we go specific to that transaction. All right, but that's a great resource. Thank you so much, Derek, for dropping that in the chat. Right.
Cool.
All right, guys. Well, here we are again. Transaction mastery. Um, Gosh, we cannot keep it to the 45 minutes. But I guess
I
it's a good
want to
thing.
say shout out to Notebook LM for my little handy dandy reference sheet, even though you can't
Yes.
see it, but shout out. Let's
Shout out. She
go.
loves no. I gotta do a class for Candace. Candace loves Notebook LM. Some people say, what is she talking about? It is it's AI design tool that I'm using now for when I type up my notes for some of the assets that I teach with. I use AI. You guys better use AI too. I just use AI to design some of the assets very quickly. Wrapping up, for those of you who are new to the room, I talked about this a little earlier. You love checklist, I know, right? um, I won't say their name because I don't know, might be jinx, but whatever. Let me stay focused. Transaction mastery. Leads do not close themselves. Leads do not close themselves. I'm going to say it one more time. Leads do not close themselves. This year, we are planting our flag in that mantra. Leads do not close themselves. And what does that mean? That means that we are committed to transaction mastery in this year. That means that even if I dump you with 1,000 wonderful, what if they're purchase ready and pre-approved, but you don't know how to move them from pre-approval to closing, then we have a problem, right? And that's where transaction mastery comes in. Take a listen to this. I always share this young lady.
To a realtor class on how to use Instagram. You know, when I started real estate, which was a million years ago, we used to go to classes on how to calculate buyer's loan payments and how to figure out what someone's house was worth, things that might be important to the buying and selling of real estate. But now I go to a class where I learn not to use hashtags anymore because they're so last year. You know, let's kind of go back to when realtors actually knew about real estate.
Oh,
What do you
wow.
think?
What do you think? I agree. And we're going to make sure that our community knows about real estate. Those of you you are light years ahead of a number of realtors today who don't know anything. They will just push their buyer over to a lender and say, let me know what they say, without being able to have a conversation with that client once they come back, without being able to have a conversation with that lender, right? Because now, like you guys just heard me and Derek going back and forth about AUS, you can have a conversation with them about how AUS was ran and seeing the full report. And like Jessica mentioned, well, if the buyer wants their offer accepted, then you can redact what's necessary. But we would be more comfortable ensuring that the AUS is ran properly. My seller would be more comfortable with knowing that the buyer has their cash to close on hand versus still working to gather that. Literally. I mean, some of you, how many buyers have you had that are still gathering their cash to close? It's not to say that that's not that person should be completely disqualified, but you want to know that. And you also want to know that they have a plan for that. So what is their plan if they're gathering the cash to close? Is it going to be gift funds? Okay, great. How are we going to make sure that those gift funds are sourced and approved? Right? So marketing is surface level. Transaction mastery is below the surface. One thing I realized, I was trying to figure out, when did we get here? With COVID, after COVID, everyone just marketing was a thing. Just market. And then you go into contract, you don't know what to do with. You get a buyer, not even going to contract, get a buyer, you don't know what to do with them. That's transaction mastery. And so marketing is important, guys, but transaction mastery is equally, if not more important, because you can buy leads, right? You can buy leads, but you cannot buy a closed transaction, right? That marketing is just the tip of the iceberg. Beneath the surface is 90% of the job. That's where the deal is going to make or break you. Okay. So again, I've mentioned this before. You can spend thousands on leads, thousands. But if you freeze when a client asks you a tough question, or you don't know how to manage negotiations, you don't know how to navigate inspection reports, you don't know what's fluff and what's a real problem, right? You don't know how appraisals are conducted, right? You don't know how to speak with lenders. You don't know what their responsibilities are, and right, and how to vet lenders, right? And how to vet the documentation and information that they're giving you. If you don't know about even dealing with what an extension should happen, then the leads don't matter, right? So we want to make sure that we keep that at the forefront. Now we are updating our communication list. Some of you are getting emails, some of you are not. You guys notice that text messages kind of just completely died the last 2 or 3 weeks. I mentioned this last week. You may have received an email where you can sign up for text messaging. If you have and you've already completed that email, great. If you have not, I want you to scan this QR code and sign up for text messages if you're interested, so that you can be notified when we're going live, when there are events or new trainings that you can sign up for. All right. If you're viewing on your phone, I would recommend that you just screenshot this, keep it as a reminder. And maybe you could grab another phone and, pull the QR code or whatever, right? But if you're not getting text messages, then you want to make sure that you sign up. We're going to start trying to send text messages again next week. Mary, I'm glad. All right. Again, I think, this is our last week. You guys have been giving some great feedback on this survey about what you need in order to be successful. For those of you who have not already taken this survey, please take this survey, purchaserelab.com/survey. This is going to inform us as to what you need, right? What you need to build the business behind the agent. All right. You're welcome. Jocelyn, you got a question?
I just want to test my mic, see if it works.
Oh, it's much better. What'd you do?
I just unplugged it and plug it back in.
That always works.
Okay. All right, thank you.
The text didn't have a link. I think the text did not have a link because it's been determined that if it has a link, it can be identified as spam. That was
I see the
intentional.
link on the text message, on my text message.
You did have a link on yours?
Yeah.
Okay, well, there we go.
The
Work
link
with us,
was
guys,
the link was to register for the session, but I knew
versus
I was
not
already
registering.
registered, so it didn't make sense for me to re-register.
Okay.
If we
find out.
opt in, then
Go
it
ahead.
shouldn't be flagged for spam.
It should not be. If you opt in,
Okay.
it should not be. So again, we are going to continue to work through that. If you got to re-register again, just know that that's why. But for the last few weeks, text messages were being rejected and all type of stuff was going on with our account. So that's where we're trying to clean that list up. All right. All right, guys.